Hi class. In this video we're going to look at some examples from chapter 3. So we're going to talk about adjusting entries for the most part. So this says consider the following situations for Shocker, and we've got A, B, C, and D, which are various transactions that they have recorded in the past. And the requirement is to record the adjusting entries for Shocker at December 31st. So just looking through these things, it looks like we have some financial events that have happened or are going to happen, and we need to decide if these financial events as they have been recorded are correct given the passage of time, essentially. So we're at December 31st. So how have these things changed, and do we need to adjust any of these entries to reflect that we've either earned revenue since then or used some things that we need to expense, or some other situation has changed due to the passage of time or some work we may have done. So item A says on November the 28th, Shocker receives a $2,700 payment from a customer for services to be rendered evenly over the next 3 months, and deferred revenue is credited. So this happened at the end of November, and it's now at the end of December. So 1 month has passed, and it says that we were to render services evenly over the next 3 months. So our assumption is that we have now rendered 1 month worth of services. So it says they credited deferred revenue to start with, which would have been in November. So we've now earned 1 month of that $2,700. So let's figure out what 1 month is worth. So we'll take the $2,700 and divide it by 3 months. So it looks like we would earn $900 a month. So we're going to come down here, and instructions told us that deferred revenue was credited when they actually accepted the cash. So now that we have earned $900, we need to do an adjustment to get that money out of deferred revenue. So if it was credited to start with, we're going to debit it to get it out of deferred revenue. And at this point, it's not deferred anymore. We've actually earned it. So our credit is just going to go to revenue, and they're calling it service revenue. So that's all there is to that one. We're just recording revenue as opposed to deferred revenue. So the next one says record the adjustment for advertising. So that one says on December 1st, the company pays a local radio station $2,340, and that's for 30 radio ads that were to be aired 10 per month through December, January, and February. So they give you a little bit more information than you need. The bottom line here is we're going to use they're going to do the same advertisements December, January, and February. So we can just figure out how much per month. We don't have to worry about the amount per ad. So $2,340 over the course of 3 months is $780 a month that we're spending on advertising. And it says when they recorded this entry, they debited prepaid advertising. So, but $780 of that is no longer prepaid. It's actually something that we've used. So if we debited prepaid advertising when it was prepaid, which it no longer is prepaid, we need to get it out of there. So to get something out of a debit, we credit it. And we're turning that prepaid advertising into an expense, which would be advertising expense, because now it is an expense. We've used that advertising up. It's not something that we still have to use anymore, at least $780 of it, because we've already used it. All right, so let's see what C is. It says employee salaries for the month of December totaling $6,800 will be paid on January the 7th. So in this example, we have employees that have actually already expended effort. They've already given us their time in work, and we owe them that money. So that is an expense that we should recognize in December because that's when they actually did the work. So we need to recognize $6,800 worth of an expense, and that of course would be salaries or wages, some kind of term like that, expense. And the credit side of that is some kind of debt because we owe them money. So anytime you owe somebody money, it's generally called a payable if it's something short term, and this one would be salaries payable. And that's all there is to that one. And then interest. It says on August the 31st, Shocker borrowed $58,000 from a bank. They signed a note with principal and interest to be paid on August the 31st, 2019. So we need to figure out how much interest we're dealing with to start with. So to figure interest, we're going to do the principal, which is $58,000, times the rate, which is 9%, times the period of time. So we've got from August the 31st to this year to August 31st next year. But at this point, we're only worried about the interest that is up to this point. So we've got September interest, October interest, November interest, and December interest. So we've got 4 months of interest that we actually owe at this point. So we're going to take the principal times the interest rate times the period of time, which is 4 months divided by 12 months, so 4/12. And I think I did something wrong. Let me try my calculator again. 58,000 times 9%. All right, that looks better. So times 9% times 4 months divided by 12 months, 4/12 of a year would be $1,740. If I have punched my calculator keys correctly, we're going to hope that I did, but we're going to check that in a minute. And because we have had this loan outstanding for 4 months, we owe 4 months of interest. That's an expense that we're not going to get back. If we paid the loan off today, we would still have to pay at least 4 months of interest. So that is an expense. So we're going to find interest expense. And since we haven't paid it yet, it is a payable. Whoops. And it would be interest payable. And let's see, where's my check mower? So once you finish those 4 entries, your adjustments should look something like mine. Like something like that. So that's all there is to it. The adjusting entries are just the process of looking at transactions that you've recorded and making sure that they're still accurate, as I said, given the passage of time or any actions that may have taken place that would have caused a difference in what you had on your books and what needs to be on your books. So let's get rid of this one and let's go to another one. All right, so I'm not going to go through this entire problem, but I did want to kind of point you in the right direction on this one. So for this one, it says you've got the adjusted trial balance for Fighting Blue Hens Corporation. So we've got data here, and we're to take this data and plug it into our financial statements. So we're actually creating financial statements. And when we do that, we have to create financial statements in a particular order because they link together. So we're going to do an income statement first, and then a statement of owner's equity, and then a balance sheet. So actually, let me jump over here. I did not do a very good job making my notes, so let's go forward. And just make sure. Come on. Make sure this is a good one to go through. Yeah, let's look at this one. Go back to the one we were at. All right, so we've got data. We are to do an income statement, a statement of owner's equity, and a balance sheet. So the trick with this is to, first of all, know which of these accounts go on which financial statement. And the second thing is to know how these financial statements link together. So I'm not going to work through all of these, but I did want to give you some guidance. So most of the time, unless they're trying to trip you up, Connect will give you accounts in a particular order, and that's because as accountants we generally list accounts in a specific order. So generally we list accounts in the order of assets listed first, then liabilities, and then your equity, and then your revenue and your expenses. So makes it a little bit easier to do your financial statements because they're in that order. So the first thing we're going to do is an income statement. Income statements only have revenues and expenses on them. So we need to find the revenues and expenses in this chart, and since they did list them in the right order, I think the easy thing is to do is find the revenue. If you can find the revenue, then everything below the revenue should be expenses, and everything above revenue should be either assets, liabilities, or equity accounts that are going to go on your balance sheet. So, or to some degree, your income, your statement of owner's equity. So our service revenue is $390,000. So we'll just do a little bit of this one. Maybe it's going to let me do something. And I already forgot what it was, $390,000. And I only saw that one revenue. It looks like we've got 4 expenses. So you'll see there's going to be some blank areas here. And I don't know why my drop downs are not working correctly. So it looks like there's going to be a couple of lines blank here. And then expenses, there's obviously going to be a couple of lines there. So I think one was advertising. Oh, salaries. Let's do that one. So salaries expense. And it looks like it's kind of adding that up for you. So you're going to list the other 3 expenses down through there. Then at the end, you'll have your total revenues plus your total expenses. And you got a choice down here at the bottom. It's either net income or net loss. So if you made more money than you spent, it's a net income. If you spent more money than you made, then it's a net loss. So revenues, we hope, are going to be more than total expenses, and if they are, that's going to be a net income, and it's going to be just this top number, and then subtract out your total expenses, which are of course there's going to be more of those. But again, don't get messed up having some blank lines. That often happens in Connect. So there's really not $100,000 here in net income, but we're going to just kind of pretend that there is, so we have something to look at. So once you get that done, and if it helps, you can kind of mentally check off these accounts as you use them, because once you put them somewhere, you're kind of done with them. So we've used service revenue, and had we put all these expenses on the income statement, we would be done with those. So the next thing you're going to do is do your statement of stockholders' equity. And you've got some columns here. So it says a balance at January the 1st. I don't think it said, it didn't give us any other information about there being changes or transactions during the year. So we're just going to assume that, well, let's just try that. Let's just assume that the beginning balances were 0. Let's give that a shot. And let's just check my work to see if it's going to let us do that. They could have been a little more specific with the instructions. Too far down. What did I do? Let's try this one. All right, so this one, it says that's wrong. So sometimes you have to take advantage of that check my work. So it looks like these balances were the beginning of the year balances. So let's try that. Common stock is $190,000. Retained earnings is $49,000. And that does make more sense. And so then our total stockholders' equity would be the total of those two. So let's add that together. And it looks like $239,000. All right. And then we've got some options here. We're going to add our net loss, add our net income, subtract our net income, or subtract our net loss. So you have to kind of think about, well, what makes sense? So up here, and this is wrong, but I made an assumption that there's a net income of $100,000. So if we had a net income, that should improve stockholders' equity because it's a good year. So we're going to add our net income, and when we have a net income, it goes in the retained earnings column. Doesn't have anything to do with issuing stock, so you can just leave that blank, and then over here the total would be a blank plus $100,000 would be $100,000. And then dividends, I don't remember seeing any, but let's see. Nope, I don't see any dividends. They didn't tell us anything about dividends, so that sounds like it should be a 0. And if there was a number, it would go in the retained earnings column, because when we pay dividends out, it comes out of the earnings of the company. So it would be there if there was one, but there's not. And then our balance would just total down. So this one would be 190,000. And this would be 149. And this would be 339. And as I said, I know those are wrong numbers, but we're making some assumptions here. So after you do that one, you have one more to do, and this is your balance sheet. And you can see your balance sheet has basically 3 sections. It has assets on the left, and then up in the top right, it has liabilities, and bottom right, it has stockholders' equity. So we're going to go back up here to our information, and we've got assets at the beginning. Then we have liabilities, and we have stockholders' equity. But the odd thing about this is we have two categories of stockholders' equity: common stock and retained earnings. But we've already accounted for those in the statement of stockholders' equity. So I mentioned a minute ago, you can kind of keep up with this by mentally checking these off as you use them, because you're only going to use them once. So we've already used common stock and retained earnings. So we just need to take care of from cash all the way down to that note payable of $29,000. So essentially what you're going to do is list all these assets, and cash, accounts receivable, prepaid rent, and supplies are all current assets, so they're going to go here. So let's just put cash in, and then the amount would be whatever cash was, $10,900. And you're going to list the rest of your current assets. Don't really have a label for the long-term assets, but the long-term assets are fixed assets, and I think there was equipment. I think that was the only one. So equipment, buildings, vehicles, land, all of those are long-term assets. So there's our equipment. So we had equipment, and that's the only one I see. So equipment would be $290,000. And this is where it gets a little tricky. Equipment depreciates. So when we do the balance sheet, we're going to have to also show the depreciation that goes with those fixed assets. So in this case, we've got equipment, and we have accumulated depreciation, which goes with that equipment. So you'll see the equipment is $290,000. The accumulated depreciation is $124,000. That depreciation decreases the value of those long-term assets. So you'll see right here, and they've got it set so it calculates for us, which is really nice. So our total long-term assets would be the value of the equipment less the value that's decreased, or the value that we've used over time, which is our depreciation. So that's how that's going to work. Your liabilities, there were some of those, and they were starting with accounts payable. So all of these things that say payable are liabilities, so you're just going to list those and the amount that you owe. And the tricky part is, here's another place that we link. So the first two financial statements, the income statement, this net income, or if it's net loss, either way, this bottom line links here to the statement of stockholders' equity. And the second link we see is that the total stockholders' equity of $339,000, well, actually broken up into these two categories, these bottom amounts are going to link to our balance sheet. So our balance sheet has a couple categories of equity. It has common stock and it has retained earnings. And our common stock, in our example, was $190,000. And our retained earnings, if we use this example, which we already know that one's wrong, but it would be $149,000, and that would go down here. And once you fill all those out, a good indication that you're on the right track is that your total asset amount would equal your total liabilities and equity amount. Thus the term balance sheet. The left side should be in balance with the right side. So that's how you're going to tackle that one. And I think the last set of problems are kind of the same, only it's very comprehensive. 16 through 23, that's it. So that one's going to walk you through kind of the same process. We're going to touch on one more, maybe, if my computer will think a little faster. So this says Seminole Corporation's fiscal year end is December 31st. We've got a partial adjusted trial balance, and it says prepare the the closing entries. So we've got three possibilities. It says to record the entry to close the revenues, and then the expenses, and then the dividends. So let's see what we got. So the first one is the revenues. So we're going to find revenues, and it looks like we have two categories of revenue. We've got service revenue and interest revenue, and those both have credit balances. So when we close out accounts, we close them out by doing the opposite of what their balance is. So service revenue has a $37,000 credit balance, so we're going to debit it $37,000. And that would be our service revenue. And I think the other one was interest revenue. And interest revenue was $4,700 credit, so we're going to debit $4,700. And that's going to wipe those accounts clean, zero them out, and get them ready for the following year. So 37, looks like that's $41,700 that we need for a credit. And when we close revenue, we're going to close it to retained earnings. And that's all there is to that one. The next one, we're going to close the expense accounts. So up here, we've got salaries, rent, advertising, depreciation, and interest. So all of those have a debit balance. So to get rid of those debit balances, you're going to credit them. So salaries expense would be credited $13,700. And remember to put your debits first. And we had rent, I think. Oops. Rent was $4,700. And you're going to keep listing those expenses down. You're going to total them up, and they also get close to retained earnings. So essentially what you're doing is increasing retained earnings by the revenue, decreasing retained earnings by the expenses. So essentially what's happening is we're putting the net income, which is revenue minus expenses, we're putting the net income into retained earnings because it is earnings, net income is earnings, and if we leave it in there, then it's retained by the company. So I'm not going to finish totaling this one out, but that kind of gives you the main idea. And then the last one, record the entry to close the dividends account. It looks like we did pay dividends of $1,700. That is a debit, so we're going to credit $1,700 to get that out of dividends. And we need a debit for something to be in balance, and that debit comes out of retained earnings because that's the pot of money that we use to pay dividends. So let's do the check my work so you can kind of see them all for what the ones most of all of them, the ones I finished. All right, so it says answer is not complete, and we know that because I didn't finish doing the expenses, but you can see this is what the revenue closing is going to be, and then the last one, that's your dividend closing, and then the second one is at least a start on how do you close the expenses, and of course you would just put the rest of the expenses in that same entry, add them up, and then debit the retained earnings for the total expenses. So that should give you some ideas on how to do adjusting entries, closing entries, and where to put things on the financial statements. I hope this video was helpful.